Good morning. Thank you for dialing in and welcome to today's webinar, reviewing the latest updates in SDLT. My name is Lucy Quick and I'm the Digital Marketing Manager here at InfoTrack. And I'm delighted to welcome back Sean Randall, partner at Blick Rothenberg, who will be taking you through the session today. Good morning, Sean.
Hi, Lucy.
So before we begin the webinar, I would like to draw your attention to the Q&A tab, which is located at the bottom of your screen. We will be running a Q&A at the end of this session, so please type any questions you might have for Sean along with your name into the Q&A box. That way, if we run out of time or your question requires further clarification, what we can do is we can then extract your information and follow up with you directly after the webinar. So that's all from me for now. I will now hand you over to Sean. Thank you very much.
Lucy, thanks so much. And it's such a pleasure to speak to you today. This is, I think, the third time I've spoken to InfoTrack or their attendees. Very privileged to do so, particularly because there's so many of you here today. So thank you for choosing to spend the next hour, maybe a bit less, listening to stamp duty land tax. So this is me, for those who don't know me. Sean Randall, I have 21 years full-time stamp duty experience, mostly at the Big Four and latterly at my current firm, Blick Rothenberg. I write a couple of books, chair a professional body, and there are a few other credentials there too, and also my details. So afterwards, by all means, give me a call, send me a line, drop me a line rather, if you have any questions on stamp duty. All right, I thought we should speak to three things. The first in particular. So the first relates to a consultation that was published last year, which proposes quite significant changes to stamp duty land tax on residential transactions. So it's important we understand what they are, what they might mean, and what the timing is. Then, as usual, really, for stamp duty land tax on residential, we'll talk to some cases and what lessons we can draw from those which have been published so far. And then finally, I'll just turn to a couple of changes that may or may not be around the corner. Okay, let's look at consultation. So this is a consultation document published last year on mixed use and multiple dwellings relief, MDR. So 6-week consultation published before Christmas, due to end in little less than 1 month. There's the link. I would urge you to read the consultation document. It's published in very clear English, I think, as always. And there are significant changes, as we'll see, to the current SDLT rules. You might breathe a sigh of relief after listening to what those changes are. You might not, I'm not sure. But one thing to take away immediately is that there is no time frame yet indicated, and we'll look at that at the end. So let's look at the background, firstly to mixed use and what the changes are. So, as I'm sure most, if not all of you already know, there are two main sets of alternative tax rates for stamp duty land tax. Those in Table A and Table B, Section 55, the Finance Act 2003. And Table A relates to residential transactions and Table B relates to non-residential or mixed. Now, that distinction didn't really matter for the first, 8 years of the tax, because the rate was the same. The only change between the two, or the only difference between the two sets, was a slightly increased nil rate band for Table B for non-residential or mixed transactions. But then in 2011 onwards, we had consecutive rate changes for residential, rose to 5, then 7. Then we had a change from slab to slice with a top rate of 12. Then the additional surcharge, or the additional rates, or higher rates, I should say, for additional dwellings, making the 12 jump to 15. And since April last year, there's been 2% increased rates for non-resident transactions, making that 15% rate potentially jump to 17. Whereas the top rate for Table B for non-residential or mixed transactions only rose by a modest 1%. So the maximum swing between the two sets of rates is 12%. So we have a big change in rates, or big difference in rates. Then let's look at how that applies in practice. Now, Table B rates, those non-residential or mixed rates, top rate of 5% applies where the transaction or a linked transaction, so a transaction that's linked to the transaction, includes non-residential or mixed property. So there is no requirement for the property to consist of exclusively non-residential property, and even an exclusively residential transaction may engage these rates where it's merely linked to a non-residential or mixed transaction. So a very generous rule, and it's hard-edged, or all or nothing. There is no apportionment between the two types of use or two types of property, and there's no minimum threshold for the non-residential elements before these non-residential or mixed rates apply. And it's not necessary to show necessarily non-residential use. Of course, that's highly relevant, but actually the meaning of non-residential property is anything that isn't residential. So this rule applies equally to, I think that's Portobello Road, a single mixed building, so a single building of retail at the bottom with residential upper floors. That's a classic mixed-use building, surely. But it also applies to a portfolio of exclusively residential properties with one or more exclusively non-residential properties. So a mixed portfolio, if you like. And potentially it applies to an agricultural, a country property with some agricultural land. So assume here that there is some land being used for agricultural purposes. So it applies to a very wide range of transactions, but it also encourages activity or behavior which the revenue wish to stop. In particular, it encourages artificially coupling high value residential property with low value non-residential. It encourages people pushing the boundaries on country properties and arguing in what circumstances land adjoining a dwelling house is not part of the grounds of the house and therefore is a mixed transaction. And it encourages, in my view, strained arguments on reservation agreements, way leaves, rights of way, woodland, tree preservation orders, communal gardens, somehow constituting a mixed transaction. So, even though the revenue have won every tribunal case on mixed use, admittedly the facts have been relatively weak and they've been on mostly agricultural properties, perceived abuse continues. And of course, litigating controversial cases does drain a significant amount of resources. So the revenue are proposing in that consultation document introducing for the first time one of two things, either an apportionment rule or a de minimis or threshold rule. So let's look at the apportionment rule, and it's not difficult really to see why this would be a complete fix. So how this rule would likely work is that the whole price would be taxed as if it were exclusively residential and also taxed as if it were exclusively non-residential, and a fraction of each tax charge would be found and then added together. So let's look at an example, and this is an example that the revenue have given in that consultation document. So suppose a farmhouse with 3.5 million purchase price, including within that 3.5 million an element of grazing land. So let's assume for the purpose of this example that that doesn't constitute part of the grounds of the house and is grazing land. And let's say that that constitutes only 70k of the 3.5 million. Well, under this rule, although there are different methods, this is likely to be, I think, the chosen method. The 3.5 million, so the whole price would be taxed at the non-residential rates. Assume for this purpose that it's standard rates due to the circumstances of the buyer. And then the 3.5 million would be taxed at the, taxed initially at the non-resi rates, then taxed at the resi standard rates, and then you find a fraction of each. So for the non-residential, you would tax that by a fraction, which is the value of the grazing land over the total purchase price, and do the same with the residential elements to give you an aggregate figure of 330,365, which is roughly 100% more of the current amount of stamp duty payable. So as you can see, in one swoop, this would completely remove the advantage of certain properties, attracting a very low stamp duty rate, or relatively low at least. What about a different type of mixed use transaction? So let's say same purchase price, different type of building this time, and let's say that the building consists of 2 flats, each worth $500,000, with, let's say, the rest being retail. So the tax on flats, this time at the higher rates, would be 2 times 30K, which will get you 60K. And the tax at on the non-residential element, or rather the non-residential rates, would be as before, 164.5. And then you apply a fraction of the 164.5, add it to the tax on the resi. This time there are multiple dwellings, so you apply the rules for multiple dwellings relief, and that gets you a slightly higher figure of 177.5, recognizing that most of the value is in the, or a significant part of the value is in the retail elements. Okay, the threshold rule is slightly easier, but has a much harder effect, or cliff edge effect. So under this rule, as proposed, the whole price will be taxed at the resi rates if the non-residential element doesn't exceed a particular threshold of the total consideration or the total value. And the revenue have set that threshold, or suggested in this consultation document, that it ought to be half the purchase price. So if the non-residential element doesn't exceed half the purchase price, then the whole transaction will be taxed at the resi rates. Conversely, if the non-residential element exceeds half the purchase price, then the whole price will be taxed at the non-resi rates. So in the case of the farmhouse, that grazing land only constitutes 2% of the purchase price, and therefore that's obviously significantly under 50%. So therefore the threshold isn't met, and the whole purchase price is taxed at the residential standard rates, which, as before, gives you a 100% increase over the current amount of stamp duty. Whereas in the different example of a mixed use building with 2 flats, that non-residential element of 2 million is obviously more than half of 3.5 million at 71%. So that means the current rules apply as they are, which is that the whole price is taxed at the non-residential rates, so no increase. And just a few comments from me. So, this rule, whichever one is used, is pretty indiscriminate. So it will affect, in inverted commas, genuine mixed use transactions, as well as those which are pushing the boundaries or which are artificial. You could argue that the unfairness or the illogical approach of the mixed use rule at the moment is merely the result of the legislation as drafted. Actually, in some cases, there isn't any abuse. It's merely the result of what Parliament enacted in 2003. The other point is that when the surcharges were introduced. So in 2016 and 2021, the 3% surcharge for additional dwellings and the 2% surcharge for increased rates for non-resident transactions. One of the reasons, as I recall, given by the government for not introducing a relief from those rates or those surcharges for businesses were flexibilities in the current rules. And one of those flexibilities, arguably, is this mixed use rule. So removing it does mean that more people will be, pulled into those regimes, the 3% regime and the 2% regime. There may be some difficulty in valuing the commercial elements, and there'll be more importance attached to doing so, a bit like the importance attached to valuing chattels on a property deal. Now, on a mixed use deal, there'll be real pressure in defending the valuation, particularly if it's just over 50% and a threshold rule is introduced. So I've mentioned that all or nothing effect for a threshold rule. It does give a cliff edge. So those properties where the non-residential element exceeds 50% attract a much lower tax charge, whereas those which are just under 50% attract a much higher one. And finally, it's really important to understand that whatever approach is taken, there is no change proposed to the rule that says the purchase of 6 or more dwellings in a single transaction is taxed at the non-residential mixed rates. So that 6 or more rule, buying 6 dwellings, not necessarily 6 titles, the number of titles is irrelevant, but buying 6 dwellings in a single transaction, that would continue to be taxed in full at the non-residential rates. All right, let's look at MDR, multiple dwellings relief. So this is a partial relief, it's not full relief. And the way it works is that the tax is calculated on the average price per dwelling at the relevant residential rates, might be standard, might be higher, might be the increased rates for non-resident transactions. And then whatever the tax found on the average is, that is multiplied by the number of dwellings purchased. So if you like, the effect of the rule is if each dwelling was purchased separately or independently, that linked transaction rule is disapplied in a way where this relief is claimed. And it was the result of lobbying by businesses to really facilitate or encourage transactions in portfolios of residential property. So that's the background. And the problem emerged in 2016 with annexes. So really until that date or that year, annexes were regarded, understandably, as part of the main house that was purchased. And therefore no one before 2016 was claiming relief on an annex, thinking that it might somehow be taxed as if it were a separate dwelling. But then we had the 3% surcharge introduced in 2016, and you might recall that an exception was given, the result of lobbying by Eric Pickles, to prevent the 3% surcharge applying in purchases or to purchases of a family home with an annex. And the fear was that the 3% surcharge would kick in because the buyer would be regarded as having bought 2 dwellings in one transaction. And so therefore there was a particular exception to this surcharge, disapplying or disregarding the annex for the purpose of the surcharge. But the whole point of that exception would have been redundant or otiose if the annex didn't count at all. So the corollary of introducing the exception meant that these annexes could now somehow, in principle, be recognised as a separate dwelling for multiple dwellings relief. So there began a practice of owner-occupiers claiming this relief on purchases of annexes. And it caps out now currently at 86.25. So just under 90K per annex is the maximum saving that this relief affords. And understandably, a large reclaim industry emerged. And I was only speaking to a neighbour last week that bought a property with an annex, who said that she had received 20 letters from a variety of firms, somehow finding her details and the fact that she had bought a property with an annex. So in this consultation document, the Revenue have said that they've been spurred into action because on a sample of reclaims, so not returns made with the relief claimed initially, but reclaims made after the event, they think that 40% in that sample are bad claims. And understandably, they have lost patience with litigation for the reasons I mentioned. So 4 proposals are made in the consultation document, all in the alternative. And all of them would be successful, really, in preventing this relief being claimed on a standard annex. So under the first proposal, the relief would only apply where all the dwellings are purchased for a qualifying business purpose or qualifying business use. So that would be investment, trading, developing, for resale and so on. So businesses would be unaffected, but an owner-occupier buying one dwelling, perhaps to live in as their main residence, along with another property that isn't to be let or is to be let, it doesn't matter. It would be hard-edged unless there is a qualifying business use in respect of all the dwellings. Under the first proposal, the relief would not be given. Then there's a partial kind of exception where the relief would be given to the extent that dwellings are purchased for a qualifying business use. So if 2 or more are purchased for investment, trading, developing, and maybe some other purposes which are allowed, then the relief would be given to that extent. It wouldn't be hard-edged as before. The third option probably is the most elegant, in my view, which is to align multiple dwellings relief with the exception for subsidiary dwellings in the higher rates legislation. So therefore, if part of a building or a building on the same land as the main house is worth less than a third, then it would be disregarded for the purpose of the higher rates. It wouldn't engage the 3% surcharge as before, but also it would not count for the purpose of MDR. So that mismatch at the moment is the thing that's being exploited and is giving purchases of annexes double SDLT advantage. No 3% surcharge, which is correct, but also it gives them relief on the annex. This would remove that mismatch. And then the final one, perhaps the bluntest one, would be, we'll only give you the relief to the extent that you buy 3 or more dwellings, regardless of the purpose that you're buying them for. So these changes, all 4 are targeted at owner-occupiers. As you can see, really the annex claims, businesses would be unaffected, perhaps unless for the last option where they buy merely 2 dwellings. Mentioned before, 6 or more dwellings or 6 or more deals, so buying 6 or more dwellings in a single transaction continues under this proposal, all of them to be taxed at the non-resi rates. And one thing which is a subtle change is that on a mixed-use deal, where the relief is claimed, the tax on the average is always taxed at the standard rates, not the higher rates, and that is on a mixed-use deal. Going forwards, the Revenue have said in the consultation document that they will remove that and say that where the relief is claimed on a mixed-use deal, then you will always pay tax at the higher rates. The mixed-use element doesn't disapply or protect you from the higher rates. Okay, here's an example. Single annex. Let's say it's a townhouse in London. A buys that house for 2.1 million. It has let's call it a basement flat. So let's assume that it qualifies for this purpose as a self-contained annex. It's in the same building, of course, as the main house. It's worth less than a third, so disregarded as a separate dwelling for the purpose of the higher rates. So at the moment, that purchase would attract tax at the standard rates of 97.5, and that's 2 times the tax due on the average. Whereas going forwards, if any of these proposals are introduced, the tax would rise by 70% to 165.750. So the annex no longer would qualify for the relief, and the whole 2.1 would be taxed at the standard rates. And let's look at the purchase of, say, 2 annexes. So A buys a £3 million house with an annex and a holiday let on the same grounds. Those are worth less than 1/3 of the total. So again, the annex and the holiday let are disregarded as separate dwellings for the purpose of the higher rates. So therefore, the average 1 million would be taxed at the standard rates, which gets you 43.750. Multiply that by the number of qualifying dwellings, gets you 131,250. Whereas, except under the last proposal, where the relief is available for purchases of 3 or more, regardless of the purpose, under the first 3 proposals for MDR, the relief will not apply, and therefore this transaction would attract tax at 273,750. So a significant change. All right, 5 flats in this case, and let's say it's a non-resident buying a £1 million building containing 5 flats, no mixed use element, of course, each flat notionally worth 200k. At the moment, the tax will be 57.5, even with the increased rates for non-resident transactions, whereas under the proposals, that would stay the same. That is already taxed at the higher rates with the increased rates. And that's because in this example, the purpose of the acquisition is investment, not owner occupation, and more than 2 dwellings are purchased. Okay, so timeline. Well, end of consultation is next month. Probably in the summer, autumn this year, there'll be a document summarizing the responses which have been received. I imagine that there'll be a draft finance bill published in the winter this year. This is the finance bill for the following year's Finance Act, which would contain the draft legislation for consultation. And this will be enacted from June, July, the following year, 23, possibly backdated from the date of the autumn budget. So how this normally works is that there is a transitional rule. So changes take effect for transactions completing after a particular date. So after the date that the rule takes effect, unless exchange of contracts was before a specified date. Unless, so you can remove the grandfathering effect, or you could remove yourself from this protection from the rate change or changes to mixed use and MDR, if to any extent potentially the contract is varied or assigned between exchange and completion, if the sale is the exercise of an option, or if the property is subsold. Not really going to talk very much to this, so possibly there might be some strategy of exchanging conditional contracts to get grandfathered. There's some subjectivity about whether a contract that's varied after the specified date always removes the grandfathering effect. I suspect both changes to mixed use and MDR are really going to cause the death, finally, of these claims farms and the reclaim industry. But the question that's more important, I think, is at what cost to genuine mixed use and multiple dwellings transactions. Okay, let's look at case law. So I think the rate or frequency of cases on annexes and mixed use in particular has gone down, but nevertheless, there are still many cases. So last year really saw the peak of the litigation. There have been 11 cases on annexes so far, including a case, an upper tribunal decision in one case, Doe, that was published only, I think, a few weeks ago. So 9 cases published this year and last, 1 this year, 8 last year, bringing the total to 11. In 2021, so last year there were 4 on mixed use, bringing the total to 7. And one of those, admittedly, is not a stamp duty land tax case. It's a Scottish stamp duty case, LBTT, Land and Buildings Transaction Tax, but it was on mixed use on equivalent legislation. So I'm expecting some more cases relatively soon and throughout the course of this year, recognizing that there's inevitably a lag in litigation. So we had a particularly hot market, as everyone will know, last year and for the last half of the previous year. And that might mean that there is more litigation, I guess, this year and next, despite the fact that the rules would have changed by then. Professional negligence claims on missed annexes continue. From what I can see, most settle, so most people try it on, and in most cases, either there is or isn't a claim. It's pretty obvious, and the amounts involved tend to be quite small, so they don't necessarily warrant litigation. So I think that reflects the fact that insurers do seem to be settling more often than not. I'm aware of 5 county court hearings on professional negligence claims in this area. They're all unpublished, so it's very difficult to get your hands on them. There might be more. So in terms of lessons, I won't talk to this very much, partly because I've already spoken to this subject and partly because these rules are going to change. But drawing the lessons from the number of cases that have been published on mixed use so far, I think these are all pretty uncontroversial, which is the appellants, so the buyer, has the burden of proof. They have to show on the balance of probabilities that, particularly in the case of a country property, that an area of land purchased with the dwelling is not part of the grounds of the dwelling. And grounds understandably has a wide meaning, which is land available to the owner occupier of the dwelling. So really the test is looking at the functional relationship of the relevant land with the dwelling. Does that land serve as an appendage to the dwelling, or does it have some kind of self-standing or independent function, such as agricultural use? And it doesn't need to be actively used by the owner occupier to be grounds. So land might be grounds even if it's used very inactively, simply because it affords privacy, security, and serenity to the dwelling. In my view, rights of way, woodland, tree preservation orders, way leaves do nothing to the classification, and some of the case law bears that out. Disproportionate size might be relevant, but the test absolutely is not whether a particular parcel of land is needed for the reasonable enjoyment of the house, which to some extent is the test for principal private residence relief for capital gains tax. So disproportionate size might count. I've seen, for example, quite a modest bungalow with 50 acres of land where understandably that is a tempting argument to run that the extra land isn't part of the grounds of the bungalow. Grazing is an indicator, definitely is relevant, but it may not be conclusive. Sales particulars and even advice have been referred to. So advice that you give or is received is potentially taken into account when determining whether land is mixed use or not. Okay, it is fact sensitive. The context isn't sympathetic. Courts are reviewing this critically, and so far all cases have been found in the revenue's favour, albeit on relatively weak facts. Stating the obvious, be cautious of sellers and agents' assurances of land qualifying as mixed use. It's really important to classify the land at completion. So the references in the legislation to date, effective date, don't refer to events which happen after completion but before midnight of that day. So choosing to do something before midnight on the completion date to create non-residential use is going to be futile. Caution against arguments that communal gardens and reservation agreements somehow engage the mixed-use rule, even if they're in respect of exclusively residential property. Those are being litigated, and we ought to see some decisions over the course of this year. Lessons from Mdr case law. Well, it's not enough to say annexes never qualify. They can, but there is a high bar, there's a high threshold, and the adequacy or suitability of part of a building for this purpose must be tested objectively by reference to, a stranger hypothetically living in that space independently, rather than a relative or a member of staff or a guest. And it is multifactorial, love that word. So you need to take into account a wide range of factors, not all of which carry the same weight. Those cases that have been heard so far have tended to look at kitchen facilities, the standard and adequacy of the facilities, whether the building or separate building has, or part of the same building rather, has external access, or whether it has some kind of communal access. Whether there is an interconnecting door separating two parts, hasn't yet, or the case law rather hasn't yet looked at the weight of planning control. I think that's relevant, but not conclusive. The courts have, I think, incorrectly placed some relevance on an intention on the part of the buyer in the context of reading the legislation in accordance with its purpose. I think that goes too far. I don't think it's necessary to look at whether there's any intention on the part of the buyer to use that space independently and let it. Some question about whether the building or part of the building needs to comply with building regs and fire safety and electrical safety regs. I'm not sure it does, provided that theoretically steps could be taken after completion to get the relevant certificates. So some areas of uncertainty or subjectivity remain that might be resolved over the course of this year, who knows? Okay, before we look at questions, just a couple of slides on future changes I thought might be interesting. So we've had some changes obviously over the years. What more are around the corner apart from mixed use and MDR? Well, I think the most obvious one is a charge to stamp duty land tax on share sales. So where a residential land-rich company is sold as an envelope, if you like, a special purpose vehicle holding nothing other than a residential property asset, then there might be at some point a charge to stamp duty land tax, as if the property itself was sold rather than the shares in the company. At the moment, there is no charge to SDLT on land-rich company sales. So that might be around the corner. There is provision in the Scottish legislation for such a charge. Hasn't been switched on. Direction of travel in the context of capital gains tax probably indicates that at some point this might be introduced. We have a flat 15% rate, and that was really meant to be a toll charge or season ticket. In other words, ensuring that the company pays more stamp duty on purchasing the property, recognizing that the property could be sold indefinitely on a number of occasions without stamp duty land tax on share sales of the company. And that kind of season ticket effect has been eroded by, the successive rate changes. So really that probably ought to be increased, that anti-enveloping rate, if you like. We saw in the autumn budget, those of you who were studying it, an incorrect reference to stamp duty land tax on the additional dwelling supplement, or the 3% surcharge, to 4%. And this was in the context of some costings, and that was a mistake. The surcharge didn't increase, but I think it's reasonable to infer that at some stage it was mooted to increase to 4%, and that went so far as to influence some costings and it was just an error in not taking it out of the costings document. So it's been looked at whether that 3% surcharge might increase. An alternative, I think, might be to ratchet it. So perhaps have 3% for owning one other additional dwelling, 4% for owning two, and so on. And I think there is one or two equivalent transfer tax regimes around the world where there is such a ratchet. So that might be an alternative way, rather than just lumping everyone together and having a 4% surcharge, regardless of the number of dwellings. And then finally, it's all about net zero, of course, and what better way of achieving that possibly in the context of housing than to either give a carrot and introduce a relief for energy efficient homes, perhaps those where the energy performance certificate exceeds, it's A, B or C perhaps, or conversely introduce a stick, a surcharge, another surcharge, for purchases of energy inefficient homes, and therefore indirectly punish the sellers for not having upgraded their homes and made them energy efficient. So possible changes on energy efficiency. Okay, just a couple of slides, unashamedly advertising a book that I write that you might find useful, which is the first edition of the Law Society Handbook. Second edition is being written right now. It should be published in the spring, and that will cover all changes since 2020, I think, when I wrote the first edition. And then finally, there is a talk I'm giving or hosting along with my favorite peers on stamp duty on subjects that I think are most relevant and interesting at the moment. So I'll chair that. That's in March. Hopefully that will be in person at Gray's Inn, and that is very good value for money, I can assure you. So if you're in the market for a whole day's talk on stamp duty, lots on residential, then that might be for you. Okay, Lucy. We've reached the point where there are questions.
Lovely, that was fantastic. So we've had a couple come through, so we'll get straight into the Q&A. How do you calculate the amount of SDLT on staircasing percentages on shared ownership properties?
God, good question. So I would say that the rules on staircasing are quite complex, and it's not helped by the legislation not being particularly clear, and also the revenue guidance either not being full or clear at all. And in general, what you need to do is treat the staircasing transactions as linked to the initial purchase, but unless the lease has been assigned since it was first granted. And remember that unless the staircasing results in the tenant, the buyer, holding more than 80% of the property, or if a market value election has been made, there will not be stamp duty in the first place on staircasing. But where there is, so no market value election has been made, and the staircasing results in the buyer or tenant exceeding 80%, well, treat all the staircasing transactions that have happened, including this one, with the initial grant, treat it as one transaction, and then you find a fraction of the tax according to the rates in force at the date of the staircasing transaction. And it might mean you have to retrospectively pay more tax on every staircasing transaction that has happened previously, if there are multiple ones which are chargeable. I suspect I haven't done justice to that explanation, but there is lots of pages in the SDLT handbook for those of you who are affected by staircasing. And by all means, drop me a line if you want me to explain in the context of a particular transaction.
Thank you, Sean. We've had a couple of queries about, is this webinar being recorded and being shared? So I'll be sharing a copy of the recording and Sean's slides in the next 24 hours, so you can refer back to his notes. Next question. What is the rate applicable where the buyer is buying the freehold of a building which has been converted into 4 flats, 2 of which already have leasehold titles in place? And there was also a note to say that the buyer in this scenario is a limited company?
Okay, so the purchase would be of a building that consists of 4 flats. I think the question says that 2 would have been sold off on long leases. So they would be disregarded for the purpose of multiple dwellings relief. So the company buyer, the corporate buyer, would be taxed if he claims relief, multiple dwellings relief, and why wouldn't he? He'll be taxed as if he bought 2 for the total purchase price. And that would give an average, and then you multiply that by 2. The rates would be because it's not a mixed use building, it's exclusively residential, the rates would be the higher rates for sure on that average purchase or average price per dwelling. Increased rates for non-resident transactions if the company is either non-UK incorporated or tax resident or controlled directly or indirectly by a non-resident too.
Thank you. There's another query. I note that recently the calculations on HMRC's calculator and HMRC SDLT return online produce different results.
Yeah, they shouldn't do. It's difficult knowing what the reason for the mistake is. One of them has to be correct, you would hope, without knowing exactly the inputs which have been made. I mean, look, I would say that using the calculator, you know, there is some health warning to using it, as well as using guidance generally. Intuitively, if there is a difference and you can't explain that difference, then you may need to seek advice or potentially speak to the revenue to find out which is correct. But I share the pain, or I sympathize strongly where there are 2 publicly available tools which produce different answers.
Thank you, Sean. Do gift transfer and property with no borrowing attract any stamp tax?
It depends. So if it's to a company that's connected by the person transferring the property, then yes. So you cannot gift or contribute by way of capital a property to a connected company without stamp duty land tax. But where the gift is being made between individuals, even relatives, there is no market value rule. So the tax only bites to the extent that consideration is given in the real world. And if the consideration is merely natural love and affection, well, there will not be stamp duty land tax. So far, natural love and affection is not a type of chargeable consideration.
Lovely, thank you. Got another question. If staircasing after assignment, therefore, does one ignore the initial purchaser price and any earlier staircasing?
I think you do. And there is some uncertainty there about whether a particular rule which says that assignees assume obligations that are inherent in the assignor's transaction somehow means that the subsequent staircasing, the staircasing after the assignment, is linked to the earlier staircasing transactions and the initial grants. And I think the Stamp Duty Land Tax Handbook has a comment to say that that is the case. And I've been persuaded that that is not the case. So I've changed my mind. I don't think the 2 are connected. I don't think that provision in the legislation has the effect of treating the 2 sets of staircasing transactions as if they were linked.
Thank you. We've had another question. How is subsale relief applied?
Oof, good question. So let's look at that. Subsale relief. This is a complete relief where all of the property that's initially purchased or contracted to be purchased is later subsold. It could be partial relief if any part is subsold. There are some prescriptive rules about in what circumstances the relief applies. And there is a particular sequence which is needed, namely a sale contract is entered into between A and B. Before completion of that contract and before the contract is even substantially performed, B must enter into a separate agreement with C, and then the 2 contracts must complete at the same time. So far as possible, both transactions complete simultaneously. There is some sympathy or leeway in technically the two transactions not completing exactly simultaneously. But if there is a meaningful gap in time or some event which needs to occur before or between the two sets of completions, that will add pressure. Relief needs to be claimed in a return. It's not automatic. It's not disregarded the initial transaction as it used to be. And there are some other conditions like a motive test. So where one of the conditions or one of the reasons for the subsale is to produce a stamp duty land tax advantage other than claiming the relief, then the relief would be denied. So it's a particular part of the code. I suspect partnerships, leases, and then subsales are the three most complicated and prescribed sets of code within the stamp duty legislation. But hopefully that gives you a broad feel for how subsale relief works.
Thank you. Is the 3% SDLT surcharge payable where a client owns multiple properties but is replacing their main residence?
Yeah, so provided that the buyer is disposing of their home and purchasing a new home, then the number of dwellings that they own is irrelevant. So they might own one buy-to-let property, or they might own 1,000, but in both circumstances, the surcharge wouldn't apply because they would be replacing their main residence. The rules can get tricky though, in circumstances where the sold dwelling wasn't recently being used as a home, or it wasn't used as a home by all the buyers. The conditions for a replacement main residence are quite tricky in some circumstances, but in essence, what I've said is totally true, that the condition for the surcharge, that 3% surcharge, there is no condition about use. So it's not relevant that the buyer intends to live in the purchased property. That isn't a condition for the surcharge, but it is a condition for the exception to the surcharge, the replacement main residence exception. But in addition, another condition is that the buyer has sold a dwelling that had been used as their main residence within the last 3 years. And of course, that sale might happen before or after completion, provided that it happens within a particular period of time. But yeah, that's probably one of the most complicated and important rules in terms of the 3% surcharge, and one where I see the most mistakes.
Thank you. We've had another question. Mortgagee in repossession is staircasing on completion. Who pays the SDLT? Does the buyer pay again on assignment/sale?
Oh, I think I probably need a bit more information about that one. Yeah, that one is to take offline, and if the relevant person would like to give their name, I will pick their brain on the facts and give my answer.
Okay, perfect. Thank you. We've had another question. Do you need to pay additional SDLT on holiday chalets if the planning permission is limiting use as a holiday accommodation only?
No one knows. So there are arguments both ways, and the revenue accept rightly, in my view, that the restrictions on use are relevant. But it's not necessarily determinative. So you probably need to look at all the circumstances, all the facts, really, to understand how that property should be classified, whether it's a dwelling, whether it's residential property, or whether it's something else. The revenue have, in their guidance, as I said before, stated something equivocal to say that it's relevant but not conclusive. Yeah, it depends. I think there are strong arguments both ways. It's not clear.
Thank you. We've had another question. Are stabling and paddocks automatically considered non-residential?
No. So if the stabling and paddocks have been used or were available to the owner-occupier as an amenity for their use, So for their ponies or horses, will that be treated as part of the grounds of the house? If instead they were in use as part of some livery business or some kind of equestrian business, then yeah, they might be regarded as commercial property and serve a function that isn't an appendage to the house. So it really depends. But if the question is, does the mere fact that there are stables and paddocks, does the mere fact of those elements of the transaction engage mixed rates? Definitely not. You need to really stress test their purpose, their relationship, their history of use to understand to what extent they'll be regarded as part of the grounds.
Thank you, Sean. We've had another one. Client is buying 2 new build flats in the same building from the same developer, both BTL transactions. Higher rate applies, but can MDR be applied?
Yeah, of course. So there's no restriction for the relief that the purpose is BTL, buy to let investment. Quite the opposite. That's exactly what the relief was intended to apply to. So the fact that they're buying 2 investment properties from the same seller, it could even be in linked transactions rather than one single transaction. But yeah, that's a classic scenario where the relief ought to apply to.
Thank you, Sean. I am just conscious of time. We have run over slightly. So I think what we'll do is we will end this session here. If you do have any other questions for Sean, or if we haven't been able to answer your question online, we will follow up with you directly after the webinar. So I would like to say a big thank you to Sean for his time today. It's always a pleasure having you on our webinar, and I hope you all found this session informative. I will be sharing the webinar and slides with you in the next 24 hours. If you do have any other questions about anything you've seen today, as Sean mentioned, you can reach out to him directly. Or if you've got any questions about completing your SDLT through InfoTrack, you can also get in touch with your account manager who will be able to assist you. All that's left to say is thank you so much for joining us. Have a lovely rest of your day and a lovely rest of your week. Thank you.
Thank you.